Hey, welcome to the Closing Beat, everybody. Happy Tuesday. How you doing out there? Everybody's good, feeling good. Yeah. Hola, grateful. Good to see you. Hey, this is the Closing Beat. We're financial advisors here at Jazz Wealth, and just getting used to all this. Got the big boy stuff like they do on TV here, and I barely know what's going on, but we do know about the markets. That is our forte, actually. We are financial advisors with fund management background. So we have our own funds here that we manage ourselves, and that eliminates all the fees, any excess 12B1 fees, AUM fees, anything like that, as it pertains to that kind of thing. And plus, it's cool. You can see what's inside your portfolio. So if you have questions about stuff, chances are I've just done a class on it and gone over it. It's good times. I hope you check us out at jazzwealth.com. Also, if you want to win $100, who doesn't want to win $100? I know it's only worth like $60 in today's dollars, but it's $100. Jazzwealth.com/guess-the-Dow. Oh, it's at the bottom of your screen there. You can take a look if you'd like to play. No strings attached. You get the drill. You know how it works, right? You want to play, you want to play. Dustin D was our winner last week. Not by coincidence, or by coincidence, not by any sort of conspiracy. Anyways, we got the stock market today. Remember what we talked about yesterday? Low volume, low activity, a lot of quiet, not really anything exciting to go on there. And that's what you continue to have in a stock market. When the biggest news of the day is something that is not related to anything that has to do with the stock market or really the economy, well, it makes it kind of tough. Now, we did have some numbers that came out earlier today. The JOLTS numbers came out. We're going to try something a little different here. We're going to go over here. And we're going to hit this button here. The JOLTS numbers actually come out. That's the Jobs Opening and Labor Turnover Survey. And we came below 10 million jobs. I wanted to share this with you because the psychological number is 10 million. Oh my God, there's getting to be less jobs. We're going to a recession. Look where we're at. How crazy is that? Yeah, we have a record number of job openings here, and so we pulled back a little bit. Now, I'm not a perma bull by any means there, but I do want to point out just ever so slight little pullback. I'd also like to mention that if we take it a step further here, and we look at the severity of the pullback, we're at 9.93 million. We were down from 10.5, give or take, and we were expecting about 10.5. No, we're extended. We're parabolic here in the number of job openings. You see it. You look around. There's places that have to close because they don't have enough people there. The severity of the pullback is not all that great. Now, the data only goes back to 2000. So this is not something we can have like a really large data set on, but if we do that and we say, let's go back to 2000, here is the percentage pullback off of highs. In other words, when we had an expansion of jobs and then pulled back from there, well, how big was the pullback here? We got about a 17% pullback off of highs. Not indicative of a recessionary type environment, but I'll throw a bone to the bears and say, you're headed in the right direction, right? If the severity of this decline continues, very quickly we start to get back to a normalized job market. So while the headlines today I thought were a little bit unfair, they were focused on, the Fed's going to have to figure out what they're going to do with these rates, and we talked about that. But a little bit unfair because it is coming from a position of strength. That's like when you have a stock and it rockets up and everything's going really well, then it pulls back a little bit. You're not really that concerned. You're like, okay, well, I had such a big run. I'm willing to see a little pullback. I'm fine with that. That is basically where we stand there. If we go over to the charts here, here's the S&P on the screen after being extended here in the short term like we talked about yesterday. Just a little bit of a break. Likely that continues unless there's some catalyst that helps us blast off through these highs. But like we talked about yesterday, where's the money going to come from? Everybody is clearly moving money over to money market funds and their savings. They don't have to put it in the stock market anymore. And so the S&P really doesn't have the juice that it used to have. It's not a bad thing, but that's kind of where things stand. We'll bounce around here just a little bit. The NASDAQ knocking on a 20 20% gain year to date. 19.75 is where we stand at the moment. That is by far the best performing index of the year, and that is largely due to tech stocks, which took the day off. Interestingly enough, there wasn't a whole lot. Amazon, I'll give you that one if you're looking around the markets, but largely a quiet day for tech, but overall for the year so far, yeah, good job. Doing great there. If you look at the Dow real quick, that is the most extended in the short term of all the major markets there. So to see it pull back today is not a big deal really at all. And there were some big moves yesterday actually in energy and in healthcare. So a little bit of a pullback today. Healthcare was actually flat on the day. Remember yesterday, United Healthcare led the way. There just wasn't anything extra left in that juice today. All the gains were made yesterday, and so not really much to get the Dow to continue its rally. Oil, well, we got the big news about OPEC and those 9 countries doing their thing there. A little bit of a pause here. It gives time for people to think about the significance of the cut. Really insignificant, right? So I saw a lot of analysts from the larger banks, Bank of America, JP Morgan, and Goldman Sachs saying, this doesn't change a whole lot. This puts a little pressure on the Fed, but it's likely not going to get out of control. So we don't see gold prices just skyrocketing. Oil prices skyrocketing from here. I don't know about that. I'm on the fence there because perception is different from what is actually happening. The perception of gold being something to be very valuable right now, and I want to be a part of it, you get this kind of crap right here. People just chase for no apparent reason and are willing to pay top, and beyond top dollar for something. So that could very easily happen to oil. I'm not sold on that one just yet. Overseas, Evergrande, back in the news there. They got their big restructuring plan that they came out with. That hurt Chinese real estate stocks. It temporarily hurt Chinese stocks that trade here in the U.S. and, of course, didn't help the Chinese markets if you follow overseas. So a little bit of morning weakness possibly on that as well. Our Jazz After Dark tonight, we're going to talk about the performance of the market wrapped around rate hikes. A little bit more in detail. I didn't have anything going on. Let's put together some data for you there. So we're going to talk about that. I would like to just give you guys a bit of a teaser here and go into some of the sector performance, which I've shared with you before. We're going to do a little bit different if we can do it this way. Here's a sector breakdown with the market up at the top, and I'm changing it. I'm calling it a hit rate. Everybody calls it percent probability of positivity or percent positive. We're going to call it hit rate from now on. Sector returns down here at the bottom following the end of rate hikes. We have 6, in fact, to go on through history. These are the ends of each rate hike. We obviously don't have 2023 just yet because we don't know if we're done. But what we did is we said, let's take each sector and track the performance going forward from the end of those rate hikes. So up here is the stock market. In 1984, stock market gained 11% following the end of rate hikes, 89.10, 95.21. 2000 was the only year the markets actually went lower after the end of rate hikes. The median return in the market is 12% following a pause or a stop in Fed rate hikes. And so that gives you an 83% success rate because we're only down the one time there. Now, if you go down further, isn't it interesting? Financials have the highest probability of being positive. In other words, the highest hit rate. All right, I'll have to say that that sticks a little bit, but I'm going with it. It's my new term. So anyways, in 1984, financials best performer there, 14%. 1989, nothing. They were not the best performer. A couple other years later, 2000, they were one of the best performers going forward. Median gain of 2% after the end of Fed rate hikes. That makes sense. It is not the best performer, however. Utilities ranks as the best performer as a whole, going through all those different cycles. Not the best hit rate there, but if you're looking for what sector has the greatest probability of gaining something at the end of rate hikes, you'd say the odds are that financials will do it. You have an 83% chance based on the data that we have from previous rate hikes. The worst, actually, is energy. I find that interesting, kind of fascinating this time, because will this time be different? But at the end of rate hikes there, you have only a couple years where energy would manage to give you a bit of a rally. Now, something's interesting here, though. This is one of those weird times where energy prices declined with the stock market. And so if this is the end of the rate hikes, you're already sitting with energy prices at a relative discount, right? So I don't know where I stand on that. You can see how sometimes you look at the data and you're like, yeah, I don't know, this time may be different. And that's what makes a market. And materials has the least odds of being positive after having at the end of a rate hike. So again, financials have the highest odds or the highest hit rate there, and utilities have the highest return. So tonight we will explore this a little bit deeper. We'll go through the stock market. We'll show each and every one of the ends of rate hikes. We'll go 6 months back. We'll go 12 months forward. We're going to do all kinds of good stuff there. So brace yourself. And then I got some data. May scare the kids a little bit. Don't let it, bother you too much, but we're going to go into valuations. We're going to go into what inflation was during all of those. We're going to go through what the growth expectations were compared to now and kind of paint maybe a bit of a gray picture for you, but I plan to dive through that and hope you'll join us. That's tonight, Jazz After Dark. That'll be at 7 o'clock Eastern time. Okay, a few stocks in the news. Really quiet day. It was hard to find stocks in the news. Yeah, there's the general stuff, the big names or whatever, but it's sort of difficult to find any news. Walmart, one of them, it's going to cut about 2,000 jobs in its warehouses. That could be a sign of some issues there because as Walmart goes, so does the economy, as they say anyways. L3 Harris here gets a big contract. I believe it was, no, I don't remember what it was. $584 million. And this was from the Air Force. Comes into a couple different chunks working on different systems for their aircraft there, but not a horribly big contract, but still that would normally not be in the news. We wouldn't be talking about it, but we're talking about it here. Lindsay, if you happen to be looking at this one, is one of the bigger decliners on the day. That's why I pointed out. If you take a look at their news, it was earnings driven. So basically, to sum up this whole thing, these guys make the sort of the water pipes that go through towns and stuff. But if you look at their earnings, they had higher sales overall, more coming in. Unfortunately, they had higher costs, quite a bit higher costs, so that one didn't help them out too much there. And Acuity Brands, just think lighting, fancy lighting. When you go into Google's office and you look up and you see all that cool lighting that they have, that's these guys. So Acuity Brands, better than expected earnings, revenues better than expected, costs were the big issue, and backlogs there. So that's sort of still rearing its ugly head out there in the world. And lastly, ConAgra, and this is more of a tomorrow thing, they report earnings tomorrow morning. ConAgra is not known for being a big mover on earnings. It is about a 50-50 shot whether it goes up or down, and usually not by much. However, boop, you can find a couple times where it in fact has gone. So it's not the best one to look at for earnings. However, it's a consumer staple. It will be focused on, and since there's not much else to focus on, that one will get a little bit more attention. Yeah, that's all I got. I don't know, I don't know what else to do. We could do this if you like. So we're looking at the sectors relative to the market, and we do this every beginning of the week at some point. I think it's interesting that financials have steadied themselves, performance relative to the S&P. Obviously, they're very discounted relative to the S&P. I found that interesting. Tech stocks steadying themselves after a big rally like that, so maybe a warning sign there just ever so slightly. I find the communication services pulling back ever so slightly there. Utilities still quiet, not much going on over in that space, along with consumer discretionary. So the moral of that story, it's kind of like Jell-O sloshing around on a plate, like there's no clear direction at this very moment. Obviously the trend is higher and everything is moving along nicely. But in terms of just a couple days, like the short-term type environment, what do you do? What do you do? I don't think you do a whole lot, to be honest. So I'll take your questions, and then if you have no questions, I have a lot of work to do today, so I will get back to that if you have no questions. Doc likes the sectors. Always fun to look at. I agree. I like looking at it like that too, because when things get moving, which they haven't been lately, when they get moving, it's pretty obvious to kind of see where we go. Not much ground clearance. Oh, on the Teslas. You guys talking Tesla, huh? Jazz After Dark. Gold does spike every now and then. Yep, and when it does, it rips. And that's the misleading part. So you're like, okay, hop on that train. The ride's over. Shoot. It's a very tough one. Yeah. Grateful. Are you a day trader there? Oh, we like to hold you for at least an hour. I have some data on that if you're interested. I will see if I can pull it up there. What are your odds intraday? Oh, is that it? No, but I think I'm getting close. Hold on just 1 second for me. Day trading's a tough world out there. You probably know that. You've been a part of that. But it's not impossible. Just a bit of a tough world. And you've got to have a money management plan there. Day trading is less about picking a winner and more about how you manage each individual trade. Of course, I'm not going to find it. Come on, man. Come on. I got it in here. I got too much stuff. Hold on. I feel it. Nope. Wait. Day traders. There you go. Here is the S&P, actually. Your percentage of time that you would be positive if you threw a dart and just day traded that way. After 1 minute, you got a 48.8% chance. This was a big study we did in the past there. You can see how it's real tough. You said an hour, so let's go there. In an hour, you've got a 52% chance of being correct if you just threw a dart, picked a stock, or picked the S&P and said, from this very moment. And if you held from open to close, again, this is why money management is so important. You're barely getting above 50-50, but if you can manage those winners and manage the losers, you're hanging in there. So you're going with at least an hour, which puts you towards the tail end of that, right? I like it. Yeah, how do you know when to take the loss on an individual stock when you don't want to hold it anymore? Well, does that answer your question? I don't want to hold it anymore. I'll just sell it. No, truthfully, when you have an individual position, that should be determined ahead of time. What's the profit you're shooting for? Hopefully you've come up with some reason why you think that's a good value and a good target. And what's the most you're willing to lose? It's the only way you can measure your success. If you buy a stock and you sell it for a loss of 3 times what you risked, okay, you're not long for this world, but you could do that. And then the next time you buy it and you sell it, you get tired of it and you sell it and you're like, I'm only down 1 time what I've risked. Okay, well, how do we measure that? How do we tell how successful you are? Your batting average, your Sharpe ratio, how do we know your win-loss ratio? So got to decide that ahead of time. Most of the time people will say, I'm either going to risk the same dollar amount and I'll appropriately size my shares, or I'm going to risk a percentage of the account or a percentage of the volatility in the stock. And I say, well, if it moves more than 8%, I'm out. I don't want to be in it anymore. Very rarely does somebody do where they say, I will give this 3 weeks. And if it's not higher in 3 weeks, I'm out. We call that a time stop. It used to be popular, but I don't often hear about that anymore. Curio app. It doesn't matter before tax day. I might have missed a tax question. I'm sorry. If there was one, I apologize there. Yeah. Oh, tax loss harvesting before the April tax day. So careful there. That's not the rule. The IRS would very much disagree with you on that one. You're expanding on your SCHD question. If one owns SCHD and also owns UPS and ABBY, would it be recommended to sell these stocks instead and just keep the ETF? Those are not like, and I said UPS. I just caught that. It's one of those days. So those are not similar. Keyword is similar. A brokerage platform will not identify those as similar. So not sure I entirely understand the question, but you should not have any problems. I'm assuming we're still talking wash sale. Yeah. How do you determine the market is no longer overbought? We continue to get this pullback right here. That would be great. Anytime the stock market extends itself beyond the 20-day average price. Some people use 21, the true Fibonacci players out there. But that's what people and algorithms use to determine overbought or oversold. So if we start pulling like a rubber band away from that, less and less people get interested. You notice how that's kind of fascinating, right? If I go over to the chart, I'll just use this is the last one we had on a screen here, ConAgra. Anytime it gets, the green line is that 20-day average. Notice how anytime it gets extended, it wants to come back to it, gets too extended that way, it wants to come back, more drawn out pullback. So as you get that momentum to the downside, that's very much true. But ultimately, we're just hovering around above and below average. And that's, as in its simplest terms, that's defining overbought and oversold. You can get really carried away with that and define precisely what overbought or oversold would be. That would be relative to the individual stock there. Oh, we lost the thing for a second. Hold on. It'll come back. It's coming. Hold on. Wait for it. I can see it over there. Wait for it. Wait for it. Continue to wait for it. If it's back, it's not back for long. There we go. We're getting stronger. Nope, getting weaker. Oh. Yep, here it comes right here. We're coming. Yeah. See, I'm in tune. That's a weird part to put there if that didn't buffer, but I'm very much in tune now with this. I can feel it. I can very much feel it. That's okay. I was done anyways. I was going to wrap it up there, and I will wish you guys a good rest of your day. Thank you for putting up with that, but all should be good now. And we'll be back tomorrow. We'll do it all over again. Take your guess. jazzwealth.com/guess the Dow. I promise you there's no ulterior motive. There's a lot of you guessing, but it's just a fun game, just a way to interact with you guys. And I will hope that you have a great rest of your day or evening. And we'll see you later on Jazz After Dark. Adios.